Sic parvis magna, all greatness has small beginnings. Whether this was said in the eternal city of ancient Rome or Silicon Valley, the principle seems to remain a true constant throughout human history. Modern startups owe their eventual success to the firm belief of their investors in this concept. In this article, we will study the third of Christensen's principles of interrupted disruptive innovations, which indicates that successful companies won't allocate resources to emerging smaller markets as they will never be able to supply the returns of revenue or growth required by a larger firm. In previous articles, we have studied several reasons as to how and why this occurs. We have analyzed how companies' growth needs the guidance of investments toward a reduced and successful set of products from their portfolio, with a large customer base and even larger profit margins. We have too brought forth the theory of the darkness of the market and how successful companies are blinded to further opportunities by their success in a given area. In this analysis, both those theories will be mentioned again as they remain important pieces of the solution as to why companies decide against investing in smaller markets. However, we encourage to revisit their specific articles for a deeper analysis of each individual feature. We talked in previous videos about the theory of the darkness of the market, where we stated that newcomers in a given industry were in a better position to discover new and profitable markets. We went on to give some examples, such as Kodak being focused on the traditional film industry, while new competitors were experimenting on digital photography. However, what seems counterintuitive and a business paradox is how these emerging companies, such as Uber and Netflix, are capable of taking such quick and effective advantage of the newly discovered market to such a point that, after some short years, they are capable of challenging the leaders of the disrupted industry. Christensen explains the situation using the concept that we will analyze today. Disruptive technologies typically enable new markets to emerge. There is strong evidence showing that these companies entering new emerging markets early have significant first-mover advantages over later entrants. Over established companies failing to take advantage of the new markets, he indicates, to maintain their share prices and create internal opportunities for employees to extend the scope of their responsibilities, successful companies need to continue to grow, but no new markets are initially that large. As a consequence, the larger and more successful an organization becomes, the weaker the argument that emerging markets can remain useful engines for growth. Many large companies adopt a strategy of waiting until new markets are large enough to be interesting. And then it's too late. Christensen develops a comprehensive analysis of this concept, tracing it back to the fast updating market of the disk drive industry in the late 80s and early 90s, and how the main hardware producing companies were able to thrive by pursuing innovative technologies instead of bandwagoning in the crowded competition of reducing disk drive physical space. Qualcomm or Intel are long-lasting proof of the soundness of his theories. Since the difficulties of exploiting new markets by established companies hinges extensively on the symmetry of growth needed by the sector leaders and the real earnings of an emerging market, the key to solving such a paradox is to somehow realign both these factors. Since the pace at which a market grows is, for the most part, outside of any one company's influence, the way to match a firm's developmental needs to a market evolution is by, in Christensen's words, placing the responsibility to commercialize disruptive technologies in organizations small enough that their performance will be meaningfully affected by the revenues, profits, and small orders flowing from the disruptive business in its earliest years. This will allow for the organic development of growth incentives within the company that matches the expected development of a market, while also allowing the established companies to claim a given market share of them. However, no matter how correct Christensen might have been, an inevitable fact must be considered that works in detriment of his analysis. His Innovator's Dilemma was first published in 1997, a time when the rampant globalization of the early 21st century brought in by the internet had not fully taken effect, a period before the complex international business conglomerates that now are common, especially in the tech industry. This limits the extent to which this theory can be translated into modern tech industry. There is a singular differentiating factor regarding modern disruptive innovation brought forth by market newcomers and their late 20th century iterations. Disruptive smaller companies in the tech market, exemplified by powerful startups that have developed a fresh and cutting-edge product and are valued at over $1 billion, are called unicorns. This term is used to represent their incredible value and scarcity. Such disruptive companies follow to a T the framework of disruptive innovation outlined by Christensen. They develop a cutting-edge product on a market in which its players are currently engaged in developing sustaining technologies, as well as grow product of investment, gathering an ever larger share of the market. The process by which unicorns grow exponentially to lure investors and fatten up IPO checks is called blitzscaling. And if that were to be all there is about unicorns' growth, then Christensen would have been right yet again. However, it is not. In an article published by The Economist, they argued about the problem of blitzscaling. A dozen unicorns that have listed or are likely to posted combined losses of $14 billion last year. Their cumulative losses are $47 billion. Their services are often deeply discounted in order to supercharge revenue growth. The justification for this is the Silicon Valley doctrine of blitzscaling in order to conquer winner-takes-all markets. We greatly recommend reading the full editorial, it's really amazing. This philosophy of empty blitzscaling is problematic because it's fundamentally unsustainable. Disruptive technologies in Christensen's framework were expected to battle with established firms for dominance of the market, which assumes a solid and lasting business model which allows them to do so. Unicorns, however, even if they rise to success products of the engines of blitzscaling, such as unsustainably discounted services or over-reliance on future IPOs, backed by a titanic amount of publicity, won't have the structure nor the strength to hold their dominance. Thank you for watching Rebel Economics. Every time you watch one of our videos, you help the channel tremendously, so if you're a regular, why not subscribe? That way you will be the first to know about when new videos come online. If you have not checked the rest of the videos on the problems that established companies have to innovate, I would recommend starting with that one about why established companies fail. It is a great premiere to some of the topics we talked about today. And if you want to hear a little more about how to do business right, check out a video on how the Switch console saved Nintendo. Once again, thank you for dropping by, and I'll see you in the next video.